Hello traders, Nick Shaheen here looking at Netflix. Let's see if we can poke fun at the people trading it after hours. Today is 420. They reported earnings after the market closed and it's down 9% or so. First of all, I did a video earlier today and shared it with members, and the scenario I depicted in it unfolded to a T. My expectations were lower if I were to guess, and I suggested how I could hedge a portfolio based on that. But anyway, to be in on the conversation, there is a chat room going on all day, and there's a link to the chat room down below. It's not free to be in it, but it's free to try it out. The link will take you to PayPal. Transactions for zero for 10 days. You can cancel. But I need to know that it's a real person, not a troll. So back to Netflix disclosures. I don't have any trades on it. I don't know anybody that has it, so I'm not trying to help anybody. In fact, I do know people that have up or down bets on it, so I'm not helping anyone. I am short the QQQ in general as a hedge, and I'm short some call spreads in SPX and RUT. So this is my and I shared my opinion of downside scenarios this week, last Friday or Saturday in a video to the members, which you would also get if you're in the chat room. The video depicted the fact that, okay, so we have overall risk just from the markets being stretched. I said they're too hot to short, but I would balance my book with some shorts, and I gave examples. So anyway, back to Netflix. So the stock is down 9%. So boy, they must have, stopped growing and also lost money. No, they didn't. This is like the perfect example of how stupid people are. Ooh, he said the S word. So the experts out there come up with estimates, and people react on estimates. Well, let's define what an estimate is. It's somebody's opinion of something. It's not fact, right? There were two facts that were delivered. And the first fact, here, let me go to it. This is Benzinga Pro. The fact is sales grew to 24% over this time last year. The bottom line, which is the actual end result of any company doing anything in the world, they could be shoveling snow, 139% increase over last year. 139% increase, and the sales increased by 24%. So let's frame this. Netflix is a growth company. Somebody actually just answered me on StockTwits or Twitter. Well, they're done with growth. And I was like, wait, what? So this is black and white fact. 139% more profitable than last year, which it shouldn't be profitable because it's spending money like crazy, and 24% increase of the sales. So forget what they do and how many members they have. If the bottom line is to make money and grow that pie, who cares if they're doing it with one subscriber or a bazillion? It doesn't matter. But people are focusing on the estimates, which is an opinion. So how about we trade the facts first? When I see evidence of deteriorating business, then I'll say, hey, you're no longer a growth company. Now I need you to be this and this and this. For now, the judgment is they're delivering the growth on the top line, and the bonus, the kicker, is that they're delivering growth on the bottom line. So that's unexpected. When Amazon started doing that, that's when the stock became unshortable. Remember, everybody was trying to short Amazon for like 10 years, and then one quarter they delivered huge profits and they shut everybody up. They said, basically, it's a spigot, we can turn it off and turn it on. So in this case, I still need proof. And trust me, I'm not a perma-bull on the stock. I've shorted it, I've gone long it, it doesn't matter to me. So this morning, somebody asked me, are you going long? I said, this looks like a bullish pattern with a neckline just above. However, today's high, 420, failed at prior failing points. So onus is on the bulls. See, my alert's still there. It didn't trigger my alert. So that would be a trigger to say, okay, maybe I'm interested in the breakout, because that would have taken us to high heaven. But I'm not going to jump the gun, and I didn't. I said, if you're asking me on a bet for the earnings, I would bet down. But it's a guess. The reaction is more to do with psychology than actual facts. And this is proof. The actual facts were huge. So you can nitpick, okay, so they didn't They didn't have as many new subscribers as before, but that's because they're rolling over COVID comps. If you don't know what that means, watch the other video. Rolling over a super duper COVID adrenaline punch to COVID stocks like Zoom and all of those that benefited from lockdowns. It's hard to beat. There's nothing going on like it right now. Okay, so that's the difference. The expectations were out of whack. So if I have shares and tomorrow we open up, by the way, nothing here is a recommendation to do anything with the stock. I'm telling you, me. If I have shares or positions on it and tomorrow they're going to be under fire because they're down here, this, for the same reason I didn't chase it up here, I would not get out here. I want to see how the supports perform. And we have at least 3 immediate bounce levels. And this orange line right here, this orange line is, it's called the point of control. And it's a volume profile. It tells me this is where buyers and sellers are pretty dang busy for this period of time. Looking back 1 year, this is the busiest. It's a tie between here and here. But this is the first one below it. So it should be support zone. Because they're busy. They're going to get busy again. People that bought it here made a ton of money. They're going to buy it again if it comes down to here. Rinse, repeat. Now, if they lose this, they're going to here. What? You just tooted its horn. I said, yes, because I'm looking for lines and breaches and momentum. So what would bring it here? A market-wide correction. So there is extrinsic factors. There are extrinsic factors at play. If the markets does correct, it will take this with it. It's a fact. The stocks will not rally. It will take everything down with it. So the improbable scenario is down here. The likely scenario is it'll have its dizzy morning, day, whatever, and it will find footing anywhere in here. So for me to panic out here is not the right thing to do. Now, I will do another write-up and share it with the members as to how I would trade it tomorrow, but that's a different story. But my beef is with these experts on CNBC and in the media and the articles. So I do business with some of them, so I don't want to call them shysters or anything, but that's the business model they're in. They make money by bringing eyeballs, like clickbait, only like attention grabber bait, whatever you want to call it. The only way they can do that is by saying things that sound smart. Oh, they missed estimates by a margin, wide margin. So who set the estimate? How? Where? What? All kinds of different potholes. How about you just focus on the black and white facts and make your own opinion? So I looked at the stock. Here, let's look at it. This is the clincher. Oh yeah, terrible business to be in, right? The blue bars are sales, revenues. The orange line is profit margin. Horrible, right? Hashtag sarcasm. Debt levels dropping. That's that orange line right here. That's assets. The blue, the green is debt. So they're both rising, but one is rising faster in a good way. Oh, this is the kicker. This is the killer for Amazon and Tesla. That's why they succeeded, is the cash flow from operations. So their own running business can generate money for them to do stuff with it, so they don't have to go to the market to borrow. Look at that. A loss of $2.9 billion in 2019. Negative cash flow from operations. So they're bleeding, hemorrhaging. And then 2020, $2.4 billion. Did somebody mention that? No. So if this fact is correct, that is huge. So that was the game changer for Tesla, by the way. They almost went out of business like 18 months ago or whenever. And then suddenly everybody loves it because the balance sheet became solid because of this. They no longer need to go beg for money to operate. Now they can implement ideas free. Oops, sorry, that wasn't what I needed to do. Okay, so income statement. 2017, 11 billion, 15, 20, 25, and now they're running at a 25 billion run rate. It's pretty impressive, right? And the net is 2.7 billion or whatever. So here, the quote valuation. This is going to blow the socks off of the argument, like in a good way. First of all, the PE is 91. That sounds high. Remember, Amazon ran 3-digit PEs for a long time. AMD did too. and now they're both very reasonable. But this is not a metric I look for growth companies, because they can't grow on a budget. Amazon could not have created what it created for the world on a budget by skimping. This is the one that matters a lot, and it's cheap, cheap, cheap. I'll tell you why. 10 price to sales. It is high relative to Amazon, but Amazon is a freak of nature. Amazon's is 4. Tesla's 24. So that's basically giving them, if you buy the stock today, you're giving them 10 years worth of credit of full year sales. That's pretty high, 10 years of sales. But it's like close to Facebook's, just above Apple. And Apple doesn't grow. So this one is delivering growth, all the excitement, and it's running at 10. So let's go and look at Facebook. Actually, no. Look at one that doesn't grow. So the argument should be in favor of this one as opposed to Netflix. There you go. All right, let's go to that statistic. 8, pretty close. But look how much inflation it got in the last 4 years. It went from 4 to 8. It doubled, right? For what? It didn't give that much increase in growth, right? So what are they? This is basically shows the expectation of the buyer of the stock. They expect so much. Here it went from 8 to 10. It's not as dramatic as an increase. So the expectations are not out of whack. With Apple, they are. So anyway, long convoluted way of saying, you're selling it? Seriously? Get your own opinion, dude, and do that. All right, so again, nothing here is an actual recommendation to pump the stock. I really don't care, but it just ticks me off when I read headlines and they just make no sense whatsoever.